Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about UniFirst Corporation quarterly report. UniFirst Corporation market capitalization of $4 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that UniFirst Corporation holds a significant advantage in their industry. UniFirst Corporation trades at a higher price-to-earnings ratio of 26 times and a lower price-to-book ratio of 1.65 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 22% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. UniFirst Corporation offers a wide range of services to various industries across the United States, Europe, and Canada. The company's primary business involves providing workplace uniforms and protective workwear clothing, including shirts, pants, jackets, coveralls, lab coats, smocks, and aprons. In addition to uniform and garment services, UniFirst also offers specialized protective wear such as flame-resistant and high-visibility garments. The company provides first aid cabinet services and other safety supplies, as well as safety training services. This includes the rent and sale of non-garment items like industrial wiping products, floor mats, dry and wet mops, and textile products. UniFirst also engages in wholesale distribution and pill packaging operations for non-prescription medicines. The company offers garment service options, including full-service rental and lease programs. Furthermore, UniFirst provides restroom and cleaning supplies such as air fresheners, paper products, gloves, masks, hand soaps, and sanitizers. The company's services cater to various industries, including automobile service centers and dealers, delivery services, food and general merchandise retailers, manufacturers, maintenance facilities, restaurants and food-related businesses, business service companies, soft and durable goods wholesalers, transportation companies, energy-producing operations, and healthcare providers. The stock price of UniFirst Corp. (UNF) has experienced a significant decline in the past year, exceeding -10.06%. The primary cause of this drop can be attributed to the termination of acquisition talks by UniFirst Corporation in April 2025. This news led to a 13.7% plummet in UniFirst's stock price. In addition to the initial decline, other factors have contributed to the company's stock price drop. In January 2026, UniFirst's first quarter fiscal results missed profit expectations despite beating revenue projections. This led to a pre-market trading drop of 8.2% and a subsequent trading session drop of around 3%. Furthermore, in October 2025, the company provided disappointing financial guidance for its 2026 fiscal year, which overshadowed better-than-expected fourth-quarter revenue and earnings. The termination of acquisition talks by UniFirst Corporation has had a lasting impact on UniFirst's stock price. The proposed deal would have valued the company at $275 per share in cash, representing a substantial premium over its average trading price before the offer became public. Without this potential acquisition, UniFirst's stock price has struggled to recover from the initial decline. The primary drivers of revenue growth or decline in the company can be attributed to several key factors across its various segments. In the Uniform and Facility Service Solutions segment, a 13% increase in revenue was observed, driven by organic growth, new account sales, and improved customer retention. Conversely, this segment also experienced a minus 13.8% decline, indicating fluctuations in performance. The First Aid and Safety Solutions segment saw a significant 15% increase in revenue, primarily due to double-digit growth in the van business. However, it also suffered a substantial minus 217.9% decline, highlighting the impact of external factors on revenue. In the other segment, a minus 2.5% decrease in revenue was recorded, attributed to the wind-down of a large refurbishment project and lower reactor outages. The company's ERP project is expected to contribute positively to revenue growth by enhancing inventory utilization, vendor management, and back-end processes. The net income of the company experienced a significant decline over the period in question. The decrease was substantial, with a drop of $8,742,000 and a percentage decrease of both 21% and 20.3%. This downward trend is consistent across multiple pages, indicating a persistent issue affecting the company's bottom line. The profit margins also suffered, with operating income margin decreasing from 9.2% to 7.3%, and net income margin dropping from 7.1% to 5.5%. These declines in profit margins suggest that the company is struggling to maintain its pricing power or control costs effectively. The combination of decreased net income and lower profit margins indicates a challenging financial situation for the company, requiring attention and corrective action to reverse this trend. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the positive operating cash flow, which measures the amount of cash generated by the business through its normal activities. In the 13 weeks ended November 29, 2025, the company reported an impressive net cash provided by operating activities of $14,851,000. This significant figure demonstrates that the company's operations are generating sufficient cash to meet its financial obligations and invest in growth initiatives. As a result, the company is well positioned to continue its success and achieve long-term sustainability. The company's debt level has undergone a notable shift over the past period. Initially, there was a decrease in total liabilities by $19,098 on page 4, indicating a reduction in overall debt. However, this trend is somewhat offset by an increase in long-term debt from $0 to $300 million on page 18. This contrasting movement suggests that while the company has reduced its short-term liabilities, it has simultaneously taken on significant long-term debt. In terms of interest expenses, there have been no significant changes reported. The variable nature of interest rates is cited as a reason for this stability in interest expenses on page 18. Furthermore, page 29 confirms that there were no notable changes in interest expenses during the period under review. This suggests that despite the fluctuations in debt levels, the company's interest expenses have remained relatively stable. The company's performance can be analyzed based on the growth and decline of its various segments and regions. Two segments stood out as performing well, with notable growth rates. The Uniform and Facility Service Solutions segment experienced a modest 2.4% growth, while the First Aid and Safety Solutions segment saw a significant increase of 15.3%. On the other hand, the other segment struggled, experiencing a decline of minus 2.9%. These results indicate that some areas of the business are thriving, but others require attention to improve performance. Management is emphasizing that the company's current performance does not necessarily reflect its future prospects. They acknowledge that inflation has had a negative impact on margins, but have managed to mitigate this effect through agreements with customers and operational improvements. However, they also caution that sustained inflation could put pressure on margins in future periods. To address this challenge, management is investing in digital transformation and growth acceleration initiatives, which are expected to drive long-term benefits despite short-term costs. A key strategic initiative underway is the multi-year ERP project, aimed at integrating core systems and reducing operating costs. Management believes that their current cash reserves will be sufficient for at least 12 months, with operating cash flows serving as a primary source of liquidity. Overall, management's outlook suggests a cautious approach, highlighting potential differences between estimated and actual results, while emphasizing the need to adapt to changing market conditions through strategic investments in growth and digital transformation. The company has made significant moves in its financial dealings through acquisitions and divestitures. In terms of acquisitions, two notable transactions stand out. Firstly, First Aid and Safety Solutions was acquired for $13.3 million, as mentioned on page 26. Additionally, another acquisition worth $11 million is recorded on page 27. On the other hand, the company has also engaged in divestitures to reorganize its operations and streamline its business. One such move involved the specialty garments, rental, and cleaning segments, cleanroom operations, being transferred to the Uniform and Facility Service Solutions segment. This change aimed at optimizing the company's structure and efficiency. Furthermore, the other reporting segment was created from the nuclear business, which was previously part of the specialty garments segment. The company's financial activities have been quite active in recent times. One notable aspect is its dividend payment history. According to the records, the company has indeed paid dividends to its shareholders on two separate occasions, with amounts totaling $6,133,000 and $5,897,000. In addition to paying out dividends, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares. The records indicate that the company spent a significant amount of $32.7 million on buying back its own shares. Concerns about inventory buildup and supply chain disruption have been raised due to several factors. One of the primary concerns is inventory buildup, which has increased significantly over a 3-month period. Specifically, raw materials have risen by $5,103,000 from August 30, 2025 to November 29, 2025. Furthermore, there are also concerns about supply chain disruption. This can be attributed to various factors, such as extraordinary events or circumstances that may arise unexpectedly. For instance, the ongoing conflict between Russia and Ukraine has the potential to disrupt supply chains. Additionally, the reliance on third-party suppliers of raw materials poses a significant risk, as their disruptions could have severe consequences. Another factor contributing to supply chain disruption is the presence of principal garment manufacturing plants in Mexico and Nicaragua. The risk of infection among employees in these locations can lead to production delays or even complete shutdowns, further exacerbating supply chain issues. These concerns highlight the need for companies to develop contingency plans and strategies to mitigate potential disruptions and ensure business continuity. That concludes the financial summary for UniFirst Corporation. Feel free to comment below, and I will be happy to answer them when possible.